My name is Olivier Desbarres. I'm a London-based independent macro and currency strategist. I worked for 15 years in investment banking for Credit Suisse and Barclays in Moscow, London and Singapore. In my last role, I ran Asia-Pacific, Asia currency strategy. So my focus has historically been very much on emerging markets. But whether I like it or not, I've spent a fair bit of time also analyzing G10 economies and fixed income markets with an emphasis on Eurozone and EU membership issues. I currently run a well-respected website with over 2,000 subscribers, and I would qualify my approach as both quantitative and qualitative. If we look at individual asset classes and markets in individual countries, there is a degree of granularity, but the overall picture is one of reasonably low volatility with few major corrections or revaluations. And I think the historical context is interesting. It's almost 30 years to the day since the 19th of October 1987 crash, also known as Black Monday. If we turn to the US, the S&P, the Dow Jones, and NASDAQ are rising at almost a metronomic rate, regularly hitting new all-time highs. And it's a similar picture for emerging markets and global equity indices. The MSCI EM equity index has not suffered a daily loss of more than 2% in almost a year, whilst the world equity index has not had a daily sell-off greater than 1.2%. VIX volatility is hovering around 10, which is low by historical standards, and in my mind points to equity markets which are comfortable with the global outlook. If we turn to currencies, the majority of developed currencies, including the dollar, the euro, Swiss franc, Nordic currencies, and Australian dollar, have, in trade-weighted terms, traded in reasonably narrow ranges for the past couple of months. Turning specifically to the euro, it had an impressive 7% rally between April and September of this year, and it's been actually broadly stable since then, and that's despite the political uncertainty following the recent German elections and independence vote in Catalonia, and despite the uncertainty about where the ECB's QE program will go in 2018 and onwards. Sterling, perhaps unsurprisingly, given the backdrop of Brexit, has been more volatile, but even so, the sterling trade-weighted index is currently broadly in the middle of a 7% wide range. Finally, the yen has been reasonably volatile, trading in quite wide ranges, given that this is a so-called safe haven currency. But I attribute this in part to this weekend's election, and I would note that the yen is now off its lows. Turning to the high yielders, including the Mexican peso, Russian ruble, South African rand, and Turkish lira, these currencies, as often the case in the past, have experienced greater volatility than low-yielding developed and EM currencies. The Mexican peso and Turkish lira are currently at the bottom of their two-month ranges, with talk of Trump scrapping NAFTA weighing on the peso, whilst weak domestic fundamentals in Turkey and the diplomatic rift with the US keeping the lira under pressure. Conversely, the ruble is benefiting from high oil and metal prices. But the overall picture is that these currencies' ranges don't particularly stand out by historical standards. And if we look further beyond these four currencies, the picture is again one of relative stability, with most currencies in 2% ranges. The Brazilian real and Indian rupee, two other high-yielding currencies, have been well behaved. So whilst a basket of high yielders has inched weaker in recent weeks, the carry trade still seemed reasonably attractive to investors. Czech crown continues its stellar run, but for other Central European currencies, it's a more benign story. In non-Japan Asia, currencies including the Chinese renminbi have shown little clear direction, with central banks seemingly able and willing to keep their currencies on reasonably short leashes. In the bond universe, we have seen US and UK government bond yields rise since early September, but by a magnitude that's commensurate with markets expecting, realistically, the Fed and Bank of England to hike rates by 25 basis points before year-end. Elsewhere, government bond yields have treaded water. Even if we look at Spanish long-end yields, which have pushed higher in recent weeks following the Catalonia independence vote, these yields have been receding in the past couple of weeks. And again, I think that points to the relative stability of fixed income markets.